Welcome back to the Talking Hedge. I'm Josh Kincaid, Capital Markets Analyst and host of your Cannabis Business podcast. Today, we're going to take a look at how the longest expansion in history is officially over as the U.S. has entered a recession. We'll also take a look at the stock market and try to explain why some investors are panic buying bankrupt companies, as well as what the central bank and the treasuries are doing, which is, of course, making a crack in the financial system, making that even larger. And of course, we're going to dive into gold and silver. February 2020 marked the end of the longest economic expansion in history that began back in June of 2009. But if you've been listening, of course, I've been saying that this is predominantly based on the Fed. They've been printing and buying equities. Right now, they've been responsible for 73% of the recent retracement that we've seen. But nonetheless, 128 months marks the longest period of economic expansion in U.S. history. The previous record was held by the business expansion that lasted 120 months from 1991 to 2001, and this is from data going back to 1854. Looking at this chart, you'd have no idea that the economy contracted so sharply back in March. It's bounced right back to its all-time record highs. So retail investors aren't just buying the dip, they're literally going out and buying bankrupt companies, big tech bonds, bullion, you name it, buy everything. And that's regardless of fundamentals. If you look at big tech, there's record valuations amid plunging earnings per share expectations, and yet people are still buying it. The Robinhood platform has got Apple and Amazon at record highs, sending the FANG index even higher. You're seeing the volatility index decoupling from stocks this last week. So with the VIX index decoupling from equities, you can maybe determine that's being driven by call buying with leverage long positions. Either way, it's not good. You can see that volatility play out in Bitcoin as it ended the day higher after a crazy move overnight. More than likely, that's a spoof. That's when somebody puts in an order just to see if somebody's willing to take it and then immediately cancels that to see where it can go. So my guess is that's going to get pushed up even higher in the coming days. This chart is showing the margin, people that are borrowing or leveraging themselves. A lot of retail borrowers are out there just borrowing money and buying more stocks at the all-time highs. It's not going to end well. Here's just one example of kind of how retail investors can mess things up if they don't really look at technicals or fundamentals and they're just speculating entirely. Last week, there was a Chinese real estate service provider, what's called FANGed. And a lot of people were mixing that up with FANG, Facebook, Amazon, Netflix, Google. And so that stock that bared a strong resemblance to the FANG stocks made so many headlines a day after that it made record highs. It sent the stock soaring 600%. And with a thinly traded stock, it's fairly easy. If you get 4,000 new people on Robinhood to trade that stock on a single day. So traders on the Robinhood platform mistakenly bought FANG, thinking that it was had something to do with the FANG index, making that the second biggest increase in holdings on the platform. So we already know that the stock market really isn't working on fundamentals or technicals. And to make matters even worse, the U.S. Treasury is about to flood the U.S. with $700 billion over the next couple of weeks. The Treasury's latest quarterly borrowing needs are around $3 trillion, and they also need to get their cash balance at the end of the quarter to around $800 billion. So if the Treasury's forecast is accurate, then over the next couple of weeks, the Treasury's cash balance has to drop by a record $700 billion in order to hit that $800 billion target. So if the $700 billion actually leaves the account at the Feds and flows into the real economy before the end of the quarter, then it's likely a massive boost for risk assets. More than likely, that cash is going to flow into more bonds, more equities, probably commercial real estate. There's a lot of mortgage-backed securities, collateralized backed securities that are in default. So I have no doubt the federal government will be bailing them out. Since 2008, low or zero interest rates have again caused an even bigger bubble in commercial real estate assets, a gold rush that drove net loan losses negative as loan-to-value ratios plummeted. And now asset prices in a free fall, loan-to-values are rising, and we expect to see net loss rates on commercial exposure solidly in the red for this quarter. In other words, there are cracks in the financial system that are getting even bigger. So what does that mean for gold? Well, fiat currency really isn't trusted by anybody. And so you can see that there are countries like China and Russia that are buying substantial amounts of gold because they're worried about the weaponization of the US dollar. The US has a lot of power with their sanctions. So Russia created an alternative to the SWIFT. SWIFT is how you send money internationally via a wire transfer. And then China has oil, so you can't really have an oil embargo. So both China and Russia have come together. They're sharing assets, and there's plenty of other countries. The BRICS countries, Brazil, Russia, India, China, South Africa, they all want to get away from the US dollar. So it's definitely going to have an impact. There are some analysts who think this is the third and final wave of the gold bull market that started last year. Actually, the initial bull market started in 2001, and this one apparently is going to be a tsunami. And that analyst goes on to say that they don't trust gold ETFs. I actually don't trust ETFs either for any commodity. If you look at oil, USO, and some of those other indexes, don't actually track it as well because of the speculation. So I don't trust ETFs. Plus, you're not even going to get your physical. So if you're buying into an ETF thinking that you're going to convert that to physical gold, it's 65 times oversubscribed. So it's not going to happen. Even the U.S. Feds may start buying gold. According to Guggenheim Investment Global Chief Investment Officer, he's warning that the Feds may start buying gold to support the dollar hegemony. He's not the first one to report this. Back in 2016, PIMCO strategist Harley Bassman suggested that instead of buying bonds or stocks or crude oil, that the Fed should unleash a massive gold purchase program that would echo a Depression-era effort to effectively boost the U.S. economy. At the time, Bassman said that the Fed should emulate a past success of making a public offer or purchase significantly large quantities of gold bullion at a substantially greater price than today's free market levels, perhaps $5,000 an ounce. The impact of a gold purchase program would increase the price as it's being recognized as a store of value. And in fact, since 2018, the dollar has been drastically losing value against gold while maintaining some semblance of stability against its fiat peers. So with the Feds going all in on financing the government deficit, the US dollar could be at risk to negative speculation of its status as a dominant global reserve currency. Investing in gold may help offset this trend. The accumulation of gold as a reserve asset historically has been seen as a responsible policy response in a period of crisis. Gold accumulation isn't just from Russia and China. Central banks added nearly 32 tons of gold reserves in April, led by Turkey. On the year, central banks have added a net 142 tons of gold to their reserves. Turkey adding that with 38.8 tons of gold. So what's going to come after the deepest economic crisis since the Great Depression? This virus is expected to result in a contraction of the global economy by over 4% this year, which could mean that this crisis will be the deepest economic crisis since the Great Depression in the 30s. There's an expectation of a very limited recovery next year, as many countries will continue to be bound to a 6-foot economy for a long time. Businesses in these countries will not be able to offer as many goods and services as they did previously, and demand will remain low for a long time. Political tensions are flaring up again, but we could expect to see a truce in the trade war to come to an end. Downside risks such as a second wave of infections or financial crisis continue to dominate. Whether we have a second wave or not, I guarantee you we're going to have a financial collapse. It just hasn't happened yet. Supply chain disruptions, you name it, it's going to happen. And so when it does, you need to be prepared. So invest wisely. With that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.